Joining us now for more on the energy complex writ large, Bill Perkins, Skylar Capital Management founder and CEO. Bill, it's good to have you back on. I do want to start with oil and crude, specifically what we've seen in the wake of this conflict erupting over the weekend. Your thoughts, because we are not seeing supply affected yet, but that hasn't stopped prices from moving higher.
No, I mean, we're looking at the asymmetric risk of supply disruptions and also the risk of demand going up. Unfortunately, war is extremely energy intensive. Those ships run on diesel. Jets use a lot of fuel. Making munitions requires a lot of fuel. It's just a very energy intensive endeavor. And so there's the demand side. And then you have the supply disruption. And also the fact that the U.S. is moving warships into the area. These are areas where there's lots of dark ships doing ship-to-ship transfers, evading sanctions. Maybe there won't be such a blind eye to that activity, thus reducing other barrels off the market. Things that CNBC is tracking, satellite companies like Skylar are tracking, these kind of sanctions evading fleet that's out there. And you guys are correctly pointing out the risks. There's asymmetric risks, and the market is adjusting to that.
Okay. This has also affected nat gas, and I realize there are a lot of factors when it comes to nat gas and those prices and as they move. But today we saw that trade at the highest level since January. One of the things that's been cited has been production shut-in of an offshore gas field off the coast of Israel. How much is it impacting that commodity?
Well, if you're talking about European natural gas, people just got their worries up, right? This is the area, TTF, that any kind of disruption, any kind of alternative fuel that they use when it's cold gets everybody scared. And we've seen kind of what I would call ludicrous pricing in TTF. And people are quite worried about the asymmetric upside to any kind of supply disruption, even though that field didn't directly affect European prices. Here on the U.S. side, where we're well supplied, we had a sympathy rally and then things backed off. Our rally over the past week has been due to the fact that we've had low wind generation, very hot temps. We didn't have a containment scenario, so spreads are adjusting. Prices are rising to an area where producers will make a good return growing production. And now people are kind of in a measurement mode in the United States about natural gas. We want to see what's going to happen with the weather and what's going to happen with producers going into the winter, whether they're going to ramp production or not.
Yes, given that winter is coming and we have this volatility in geopolitics, how do you expect that to affect the energy trade over the next quarter or so?
Well, our firm historically has been bearish, but the bearish bets are winding off, or we're not bearish anymore. We're very cognizant of the asymmetric risk to the upside with winter coming, as you say, and the fact that we have a lot of intermittent power sources, right? We have a lot of wind and a lot of solar on the grid. And if those things don't show up and it's cold, we can have, significantly higher pricing in the U.S. Luckily, we have a lot of domestic production, not so much for Europe. They are on a model where they're bidding on the open market for cargoes. And so if it's cold in Asia, they got to outcompete Asia. If there's a supply disruption, well, they got to go to an alternate fuel. Oh, by the way, there's a war going on. The alternate fuel's in short supply. So they're a little bit more jittery, and they have more asymmetric risk to the upside than the United States. But all players are slightly concerned and adjusting their price distributions currently. And, Skylar's in a wait-and-see mode. We're measuring and measuring and measuring, and we're going to see what happens.
All right. For your insights, we thank you, Bill Perkins.